According to the internet, Albert Einstein would have said that compound interest is the eighth wonder of the world, that those who understand it receive it, and those who do not pay it. Now, there's very limited evidence that Einstein ever said these things, but the fact that we attribute this concept to a genius like him highlights how important it is. Now, with dividend investing, there's a triple action of compounding, which increases your income exponentially over time. And this is what I'll be exploring in this video, proving it with simple real life examples, nice charts, nice visuals, so that even if you're not an investment expert, you'll be able to follow along just fine. By the way, I'm Sam Kovacs and I run the Dividend Freedom Tribe, an investment subscription which is geared towards individual investors like you who want to retire rich on dividends. We run it on Seeking Alpha with my father Robert, have over 100 5-star reviews, and if you want to learn more, I put a bit of information in the description. Before we dive in, just a quick reminder on how dividend growth investing works. Essentially, you allocate your assets, your savings, to a portfolio of stocks which pay a recurring and growing dividend. This means that each year, these companies will be paying you a growing amount and you'll be reinvesting those dividends to buy more stocks. You'll also be allocating more of your savings towards buying more dividend stocks. And that is the short version of how you get a triple action of compounding. Now, we're going to be diving straight in with an example of how this works. We'll be using Goldman Sachs as an example, and here I am in our Dividend Freedom Tribe terminal to do this, where we have our proprietary charts, our ratios, our scores, and down here an income simulation. Now, we're using Goldman Sachs because I believe it's a fantastic stock to own right now. I did another video on that topic, and I'll be just showing the potential of its income from an investment point of view. Right, so today Goldman Sachs yields about 2.5%, which means that if you invest $10,000, and this is shown here on the in our simulation tool in Goldman Sachs today, in the first year you can expect to receive $253 from Goldman Sachs. And if Goldman Sachs never increased their dividend and you didn't reinvest those dividends, then every year you could expect your Goldman Sachs investment to lead to an extra $253 in dividends, right? And that's what you'd collect every year. But what we do know is that Goldman Sachs does increase its dividend, and in fact, it's been doing so at more or less double-digit rates for the past decade. Now, I believe that a 10% growth rate is reasonable for Goldman Sachs, and all of a sudden we see that if all we did was invest $10,000 in Goldman Sachs today and then wait to collect dividends, then while this year we'd receive 250, next year would be 278, and 10 years from now we'd be receiving $656 in dividends per year. Of course, these would be paid quarterly, but this is the yearly amounts. Now, say that we take this $253 amount and decide to reinvest it, buying more shares of Goldman Sachs at an assumed 2.5% yield. We'll assume that Goldman Sachs yields a constant yield through time and the stock price increases at the same rate of the dividend. Of course, it will be a lot more erratic than this, but for simulation purposes, it works quite well. So here I'll just tick that we're reinvesting the dividends over the time frame, and we get these blue lines. As we can see, at first, it doesn't add much, right? Reinvesting $253 at this low yield will add $6 to your income next year. But within 10 years, these reinvested dollars will add up to an extra 185, taking your investment in Goldman Sachs, which was initially going to provide $656 in investment, to an extra $185 for a total of $841 per year, or 8% of that initial $10,000 you invested. Now, things get really interesting when we add more cash every month, right? Let's say that, since we're starting with a small amount of 10,000 for this simulation, that will add $100 per month every month until the end of the period. Boom. Now, what does this do? What we see is that we're buying more shares, about exactly $1,200 worth every year, which is further adding to the income. Now, doing this starting with just $10,000 and adding only $100 a month, well, an investor would be able to collect 1,440 in dividends in year 10, which is about 100 and a bit dollars per month. Now, let's say you actually had $100,000 to invest and you'd be investing $1,000 a month. Now, if we rerun this, now of course we'll see that it's exactly 10 times as much. And so in doing this, in 10 short years, an investor would be able to generate a stream of income of over $1,000 per month. Now, of course, the astute watcher will clearly understand that there's a relation between both the dividend yield and the growth rate. And we'll look at a couple of other extremes to see how this evolves and give you an understanding of the triple compound effect of dividends. So we'll go back to our $10,000 and $100 every month example, which provided $1,445 in annual dividends 10 years from now with Goldman Sachs. Next, we'll be looking at Verizon, which I believe is also an amazing dividend buy today. Verizon has been growing a lot slower than Goldman Sachs, right? The dividend has been growing at around 2% per year for the past decade. Now, the difference is that Verizon yields 6.8%. And we'll see with the simulation that this changes things quite a bit. If we started out with just collecting the dividends on a $10,000 investment, you'd see that a Verizon investment would produce about $670 in dividend every year. Now, we know that the Verizon is very likely going to continue growing at the snail pace of 2% per year, which gets us to about $824 in dividends in year 10, not unlike the amount we'd receive from our Goldman Sachs position, showing that a lower yield growing at a higher rate will eventually catch up with the higher yield. However, this doesn't yet consider the fact that we'd be reinvesting these dividends. The second we reinvest these dividends, what we see is that 10 years from now, our simulated investment in Verizon would generate $1,850 per year. This is off an investment of $10,000 with the dividends being reinvested and the dividend growing, showing two levels of compounding. Now, once again, we're going to add in our periodic investment of $100 a month. And this is where things would really take off with Verizon, right? Where the investment would produce in year 10 $3,550 per month per year of an initial $10,000 investment and $100 monthly additions. Now, if we scale this up to saying someone who has $100,000 and is investing $1,000 a month, well, here you've got your framework to generating $3,000 per month with such an investment. On the other end of the spectrum, we have stocks which have very low yields. Microsoft is an example which comes to mind. Microsoft yields just 0.75%, but during the past decade, it's been growing the dividend at 10%, not unlike Goldman Sachs. Right, so if we set the first level of compounding, which is just receiving the dividends, you could expect $75 of a $10,000 investment per year. The second those dividends start growing at Microsoft's 10% rate, well, you'll realize that that will grow up to $195 in 10 years, which is significantly lower than both Goldman Sachs and Verizon. Next, if we add in reinvesting those dividends yearly, it adds a little bit, but that dividend is so low that even over 10 years, it barely starts to move the needle. Furthermore, we add, like we did previously, $100 every month, and you'd see that in 10 years, you'd receive $350 from your Microsoft investment. Now, does this mean that if you're a dividend investor, you should necessarily chase high yields? No, not at all. It does mean that there should be a consideration for the level of yield and the level of dividend growth. For example, Microsoft for me is a growth stock. It's not really a dividend stock because for it to be attractive to me, yielding at 0.75% yield, I need it to grow its dividend at 25 to 28% per year. This is something that we calculate and would be a topic of another video. But Goldman Sachs, which yields 2.5% and grown at 10, 12% per year, would for me be attractive. Why is that the case? Because let's remember that Verizon yields 6.7%, right? And with this same simulation, Verizon would be yielding $3,557 per year in year 10, whereas Goldman Sachs would be yielding $1,445. So that's just over two times more. But at the same time, one could say, well, there's going to be capital gains in Goldman Sachs, and there's going to be the possibility for this position to have increased in value a lot more, which is when investors will get the opportunity to yield up. What does that mean? That means while you're still going towards retirement, you're going in stocks with lower yield and higher growth. And as you get closer to retirement, you sell those positions and move into Verizon, for example, assuming both stocks still yielded 2.5%, well, then you'd be moving out of your Goldman Sachs and into Verizon, which would provide similar levels of income, probably even a little bit more income from moving from Goldman Sachs to Verizon because of the capital gain associated. I'll be looking at the concept of yielding up in detail in another video. So make sure you leave a comment saying if this was helpful, that you subscribe. And if you want to learn more about the Dividend Freedom Tribe, check out the link in the description.